Hello, I'm Bernard Hickey from Eurostoxx and welcome to 90 at 9. This is your morning briefing where you get everything you need to know in 90 seconds at 9 o'clock. Starting now with news, the New Zealand dollar has firmed against the Australian dollar overnight to near a one-year high. It's up to 79.6 Australian cents. Now this is all because Australian interest rates looks like they're falling while ours are steady, and that makes the New Zealand dollar relatively more attractive than the Australian dollar. Our official cash rate is seen as steady until maybe 2014, but the Australian rates are looking to drop maybe as much as 0.5 to 1% over the next year or so. That's because we're seeing a divergence in the commodity prices that New Zealand and Australia face. Remember, Australia depends on exporting hard stuff, particularly to China, iron ore and coal, whereas we depend on exporting milk powder, the soft stuff. And our prices, milk powder prices, are a bit firmer at the moment because of this big drought in the United States. Also, this is difficult for our manufacturers. With the New Zealand dollar higher versus the Australian dollar, this makes their life more difficult. Remember, our New Zealand dollar has been relatively low versus the Australian dollar over the last few years, which has really helped them, when at other times our currency has been stronger against others. The key here is China. It's very weak. That's hitting Australia hard. Meanwhile, the New Zealand dollar at about 82.4 US cents. The risk off trade is certainly the key overnight. The big Bazooka, the European Central Bank plan, its half-life looks to have expired about 3 to 4 weeks after the announcement. Eurostoxx down about 0.5% overnight, oil and gold down. The fears are that there's various stimulus plans, money printing and the likes, in the US and Europe may not be enough to get the global economy going. The focus is really back on Europe now with these riots in Spain, fresh marches due this morning, and a fifth austerity package from the Spanish government in less than 9 months to try and squeeze their budget back into something like a surplus. European stocks fell 2.7% overnight. There was a strike in Greece and renewed doubt about plans for a Spanish bank bailout. The Germans and the Finns say it actually should be Spain that bears the cost there. And finally, in America, the Philadelphia Federal Reserve's boss, Clarles Plosser, says that QE3, or QE Infinity if you like, won't actually boost growth and hiring. I'm Bernard Hickey. That was 90 at 9 from Eurostoxx.